And I think if equity markets would fall, maybe because we get an external shock coming from a recession, which I don't believe will happen, or from problems in the Middle East, we would increase the equity holdings in our portfolio because it's typically a good time then to buy equities.
We talked about the markets, that the markets are good, that everyone is quite, or not everyone, but more or less, the most are quite positive at the moment. But we have a lot of turbulences. So what's key for you for your asset allocation and, let's say, multi-asset generally going forward?
Well, I think in the short term, clearly, it's the US election. And I think the main difference will be where should the regional focus be, US, or can we basically move more towards Europe and emerging markets? Definitely under Trump, that will be a hard move. So from that perspective, I would wait with any moves in this regard. So we are quite neutral on a regional basis at the moment, waiting for the election outcome. But on the medium term, as I said, I find it hard to be very bearish. And from that perspective, it's commodities, it's decent position in equities, it's credit, high yield, and in particular also investment grade credit. Less so on the sovereign side, in particular with regard to long duration, because we are not convinced that inflation has gone away completely, and that bond yields will fall much from where they are, at least on the long end of the curve.
Yeah, we just recommend really a diversified multi-asset portfolio, relatively simple. So we have quite a percentage in private assets as well, as I mentioned, whether it is private equity or conservative real estate investments or infrastructure, renewable infrastructure. That's one thing which stabilizes portfolios and ensures that you can earn the illiquidity premium. So that's one thing. And on the liquid side, we would also be just quite diversified. We do like still the technology sector, yeah. As I mentioned, but we would, we are overweight tech, absolutely. But at the same time, it should be balanced with, and we have then defensive growth as a balance, which is whether telecoms, insurance companies, so sectors which have defensive growth, so to say. And that is our focus, and that is also utilities. So we have a mixture of being offensive on tech still, and have defensive growth on the equity side. And on the regional side, we do like Japan and, as I mentioned, and the US more than Europe. So that's how we are basically allocated. We are not really betting big time on having a big overweight on the equity side. That's not the way we would basically confront the current situation, because there might be some headwinds. So therefore, that's the way how we would structure a portfolio and construct a portfolio. And on the fixed income side, we do like, as I mentioned, still high yield and corporate bonds, shorter maturities, and as a hedging instrument, there is gold and longer-term government bonds.
One learning for us in the last couple of years was that it wasn't really helpful in changing tactical positions with a high frequency. So for the time being, I would basically prefer to stick to the current allocation structure, which is slightly overweight equities, slightly overweight US equities, actually, slightly overweight US tech equities. It's kind of boring, isn't it? But that's how it is.
How about China? Still not invested?
No. We will basically stay to that zero allocation for fundamental reasons, because we think, of course, I mean, you can have a fiscal or monetary stimulus and then equity market goes up because you have a short squeeze. But from a fundamental perspective, I think it's getting worse and worse all the time. So we are not a fan of China, not at all. But I think it's okay to go up with exposure towards small and mid caps during the next maybe couple of months. And it's also okay to increase duration by a little bit. And then we have quite a bit exposure to alternative liquid, semi-liquid products, which have more or less no correlation to the equity market. But there product selection is very important. It's always great to talk about that segment, but it's very difficult to find good products, right? So that's really a selection topic more than anything else. And then we are also looking at private debt, private equity, maybe in an LTIF structure. We'll see. But for the time being, we will, I think, stick to our slightly positive allocation, equity allocation.
Look, I remain pretty optimistic. I would start to diversify within equities. I do think now's the time to start thinking. We're mid to late cycle. Obviously, kind of quality defenses tend to work, but people are seemingly quite light in their value allocations. We've talked about the low positioning outside the US. I'd actually be quite constructive on China, for example. Now, I might wait for the election to, as a clearing mechanism, to really get excited there. But I do think it's an interesting time to look outside the US. I think it's an interesting time to start to look outside, that small cohort that's really driven the market. I'd agree on the barbell approach on, public fixed income with, some high yield credit as well as longer duration govs. And look, I think private credit remains really interesting. I think it's very much more interesting than private equity at the moment. But I think the illiquidity premium remains, and I think we're going to continue to see big increases there.
In the current situation, we would also stick to the slightly optimistic positioning we have, which basically means that we have a small equity overweight. We stick to the US allocation as a bigger overweight. We are currently neutral on emerging markets. We are watching the situation, especially in the light of the US election, because it might definitely change the road forward. We just got the news that over the weekend, new financial measures might be taken out of China. So the question mark is what's going to happen there. The reaction we have seen on the market was purely for us short covering of positions and risk management practices. If you've been overweight, the market reacted so strongly. But on the fundamental side, the measures, the stimulus package, we don't think that it's really changing that much. So we need more of this to come to become very confident on emerging markets. But big question mark is the US election. With regard to the bond side, we were actually playing very actively on the duration side, because this year has shown how often we changed our expectation with regard to the rate cuts. And so you can actually be there quite active. And so we had longer duration than we shortened the duration. So that was something which was good. I think the question we have not mentioned here is the question of the selection on the bond side with regard to France, for example. So that's certainly something which is a topic for us too, because we have a European portfolio. So France is a big question mark about the future and the development we will see there. With regard to the credit spreads, we think it's already very tight. So maybe it should be a first moment to reduce there. Maybe too early. It's a very highly discussed topic with our fixed income specialist, but the first signs are showing towards reduction there.
Does he want to reduce or you?
Well, he wants to reduce. Yeah. I want to stay.
I think it's always a problem to be pessimistic as an investor. Therefore, we continue to be optimistic over the next couple of months. And I think if equity markets would fall, maybe because we get an external shock coming from a recession, which I don't believe will happen, or from problems in the Middle East, we would increase the equity holdings in our portfolio, because it's typically a good time then to buy equities. Second point is, I think other asset classes like private credit and private equity are asset classes which are really, really important for long-term investors in the future. And that's another focus we have in our portfolios.
And do you have cash positions, or would you reduce something else to add to the equity side?
Well, we have, of course, some cash position always in portfolios, and it depends. We have different profiles. We have some portfolios which have typically invested up to 40% in equities. Some are 100%. So, of course, we have cash positions. But of course, when markets would drop significantly from these levels, I think it's a very good advice for long-term investors to use cash and increase equities right now.
Yeah, I would also agree to that. And actually, for us, it's probably not decisive whether the market goes up or down. So we are less about directional positioning. We are a lot more about selection, which is, we pride ourselves being stock pickers. And for that, we could easily face a first half year of 25 where, the large indices go sideways. And still, there is good value in some companies. So outperform the larger indices by proper selection. So this is where we look at first. So from that, I would say, if the tensions in the Middle East, prove to be contained, the election dust settles, we think, that probably is a good time to look at it again. And also, again, about selection after we have some clear views on that. For rates, or particularly for corporate bonds, we think, if you just look at the year where, we have seen floods, record new issuance of corporate bonds coming to the market, taking the market, sometimes, with negative new issue premiums where, the new issues yield at lower level than the secondary market. We think, there's a lot of money waiting on the sidelines or from shorter maturities to work up the curve, and therefore we think there's still some way to go for steepening, which is positive for the rates, or the other way around. We think, long duration is still a good value, but of course, the expectation or the performance potential get thinner by the moves. And effectively, we also would agree that adding private equity, venture capital, private credit probably is not a bad time. Probably we have seen peak demand in private equity, but that also spells value for buying. So it's just the other way around. When everyone is buying into that, probably the value is depressed. So now we are thinking it's a good time.
You might be surprised. I liked your cautiously optimistic, Thorsten, from the beginning, despite the fact that the outlook from our side is probably the most defensive one. We came into the year with a high overweight of risky assets overall. We significantly reduced this over time, having been more or less neutral on risky asset, to be defined. Having been even a little bit underweight, expecting that there would be something coming on the bad side. But most recently, so to answer your question, Tim, no, we are more or less fully invested. We are slightly overweight on equity. We are underweight bonds because we substitute this via hedge funds, so we increase that. And since we have the MSCI all countries approach, it was for us an active decision not being in China or only being reduced on China via our hedge funds and via our private markets investments. So we had this for a long time underweight. We increased emerging markets, we increased China, we increased private equity due to the reason that although it's long term, we want to have exactly the risk return profile there. And so finally, cautiously optimistic outlook. Being with one foot almost close to the brake, but still on gas. That's more or less the way we are invested. And obviously we put a lot into our volatility structures to gain risk premia, to have additional premium approaches embedded.
Thank you very much. And I'm very optimistic that lunch is served now. And so thanks again for the discussion. And happy to have some network now and maybe go a bit deeper into the topics while lunch. So thank you very much, everyone.
Thank you.
Thank you.